And today we're going to talk about 3 reasons the IRS loves law firms like yours. And they really do. All right. We are giving them money and losing money to them every day that we should be keeping. Before we get started, though, I wanted to share one thing with you. I think I'm required to do this as part of my presentation. I have a free download, right? I have something you can get for free. Trust account reconciliation is the bane of most law firm owners' existence. I've got a free training, free download that sort of outlines how to do trust account reconciliation quickly and easily, kind of demystifies the process. And there's also a cheat sheet. It's more like a monthly form that you can use that just walks you through step by step how to reconcile your trust account. So if you're doing trust accounting and you want some help, if you want to just learn the process, you can go to that URL right there, bigbirdaccountling.com/trust account. And there's just a little, obviously, put your name and email in there and you can have that. Hopefully, by the way, by the time we get through this, you're not dead set on doing your own trust account reconciliation, but knowing how to do it is half the battle. You can know if somebody's doing it correctly. You can know what questions to ask when you're looking for someone to help you. All that's in there, okay? And there's a little link in the chat as well. These are the 3 things that we're going to talk about, the 3 ways that the reasons the IRS loves you: your aversion to risk, financial laziness and disorganization. So we're having a real talk today. Not going to be nice to you guys. And failure to grab low-hanging fruit. These are the 3 main things that are preventing your business, your personal finances from sort of maximizing your tax strategies in a way that is actually sustainable and that you can actually implement. We're not talking about some crazy real estate tax strategy here. We're not talking about doing all kinds of weird oil and gas futures and stuff like that. This is sort of nuts and bolts stuff that everybody should be doing that most law firm owners are just missing out on. We're also going to talk about how to overcome those challenges. Bookkeeper, by the way, this is going off the rails here a little bit. One of the things that great books can show you is not just like how much money you're making, where your expenses are going. You can also forecast your tax liability for the year when you can see what your profit is. Don't be afraid to get in there and get a bookkeeper. So reason number 1, the IRS loves law firm like yours. You are unnecessarily risk averse. Okay, this is probably the number 1 quality of law firm owners across the board, including myself. All through law school, all we're taught is don't mess up, be careful, don't make mistakes. People are out to get you, all that kind of stuff. And that carries over into our financial lives. And it definitely carries over to the IRS. You know, the reputation they have is coming after you. Nobody wants to get audited, all this kind of stuff. The truth, though, is maximizing deductions and using legal tax strategies will not trigger an adult. An audit, utilizing the law and having good books, will not trigger an audit. If you are doing sneaky stuff, if you are doing things you're not supposed to do, you honestly still won't trigger an audit, most likely. But if you do, you just have to pay for it. Here are the audit rates for small businesses. Sole proprietorships, this would include like single member LLCs, pass-through entities, is 1 to 4%. Okay, S corps, this would include an LLC with an S corp election. You're looking at around 0.5%. Partnerships, 0.4%. And then small C corps, around 1. A lot of people, a lot of CPAs, a lot of other law firm owners, I don't know, often try to talk people out of taking an S corp election on their LLC because they think it increases the audit risk. It actually decreases your audit risk. And there's a good reason for that. Why are S corps one of the lowest audited business? Okay. First, to create an S corp, you have to have some understanding of how the tax system works, right? You've got to have a certain level of expertise, of wherewithal in your business background to know that you even need an S corp. You have to keep more detailed records most of the time, because if you're doing S corp, you do have to file a separate tax return. It's called 1120S. It's like a business tax return. You have to provide specific information on there, P&L, things like that you don't necessarily have to do when you are just like a Schedule C LLC or sole proprietorship. The IRS, I think for that reason, just assumes that you're more sophisticated, that you're going to be taking detailed records, that you're going to be keeping receipts, doing all that stuff that you're supposed to do. Also, just real talk, it's easier for the IRS to find problems with pass-through entities. There's much more likely that you're going to have personal and business expenses together. There's much more likely that you're going to try to put personal expenses in your business sort of P&L. So that's where they linger. That's where it's easy to find low-hanging fruit for them, which is what they're doing. So this idea that taking the S corp election, being risk averse, to doing what the government, the IRS wants you to do, it's just not true. And this is sort of equivalent to what we do in our daily practice. You know, would you tell your clients not to take advantage of the rules in your area of practice? You know, people call us and they say, in my estate planning, I own a law firm for those of you that are new. So in our estate planning practice, people call and they want to give their house to their kids while they're still alive. I say, don't do that. Wait until you die and give it to them. You get a step up in basis. You're going to eliminate all of your capital gains tax. Why wouldn't I do that in my own business? Take advantage of these tax rules. Okay. It does not increase your risk of audit. It does not mean you're a bad person. It just means you're playing by the rules. So take advantage of these rules, learn these strategies, implement these strategies, save money. Your irrational fear of an audit is costing you thousands of dollars a year in tax savings that you are entitled to. Real talk. The solution here: trust the rules to work where they are, work the way they are, and use them to your benefit, just like you do in your law practice, just like you do for your clients. Treat your business like your other client, okay? And a quick aside, okay, the tax code exists to encourage you to take specific action to save on your taxes. These laws are in place because they want you to do those things. They want you to invest in real estate. They want you to invest in your business. They want you to invest in employees. Okay. There are reasons that you can write these things off and not pay tax on them because they want to encourage you to do them. So instead of thinking of the tax code as, you know, some sort of sinister thing that is designed to cause you trouble and to get you in trouble, think of it as a playbook for success. Okay. They want you to do these things, so do them.